There's a famous joke in economics that goes like this. Two people are walking down the street, an economist and his friend. The friend spots a $100 bill lying on the sidewalk and excitedly points it out. The economist doesn't even bother to look down and keeps walking. "That's impossible," he says matter-of-factly. "If there really was a $100 bill on the sidewalk, somebody would have already picked it up." This joke captures a profound paradox at the heart of modern finance: the efficient market hypothesis. The theory suggests that market prices already reflect all available information, making it theoretically impossible to consistently beat the market. Yet despite this, thousands of professional investors wake up every morning convinced they can do exactly that. And here's where it gets really interesting. Some of them actually succeed. Take Renaissance Technologies' Medallion Fund, which has maintained an astounding Sharpe ratio of 2.5 after costs, one of the highest risk-adjusted returns in history. This is nearly twice the typical market average of 1.0 to 1.5. But for every Renaissance Technologies, there are countless failed attempts. Recent data shows that between 2020 and 2024, only 30% of active fund managers consistently outperformed their benchmark indices. Even more striking, when we look at top-performing funds from previous years, none of the equity funds that were in the top quartile in 2015 maintained that position through subsequent years. So what's really going on here? Are markets truly efficient, making outperformance impossible? Or are there genuine $100 bills lying on the sidewalk for those who know where to look? To answer this, we're going to do something different today. We're going to reverse engineer both the spectacular successes and the painful failures in beating the market. By the end of this investigation, you'll understand why even the smartest economists can disagree about whether that $100 bill on the sidewalk is real or just an illusion. To understand market efficiency, imagine three increasingly fortified walls protecting a castle. Each wall represents a different form of the efficient market hypothesis, and each is harder to breach than the last. The first wall, the weak form, suggests that you can't predict future prices by analyzing past prices. It's like trying to predict tomorrow's weather by only looking at historical weather patterns. You might spot patterns, but they won't reliably tell you what's coming next. This is why technical analysis, trying to spot patterns in stock charts, is often compared to seeing shapes in clouds, entertaining, but not reliably profitable. The second wall, the semi-strong form, proposes that all publicly available information is already reflected in market prices. When Apple announces record iPhone sales or Tesla reveals production delays, the market price adjusts so quickly that by the time you read the news, it's already too late to profit from it. The speed of this adjustment has become breathtaking. In the 1990s, it might have taken days for markets to fully process new information. Today, with algorithmic trading, price adjustments happen in milliseconds. Modern exchanges like NASDAQ and BATS have achieved turnaround times as low as 3 milliseconds. The third and final wall, the strong form, suggests that even private, insider information is reflected in market prices. This is the most controversial form, and few economists believe it holds completely true. After all, insider trading laws exist precisely because private information can provide trading advantages. But here's where it gets fascinating. The mechanisms driving market efficiency have evolved dramatically. Consider how information flows today compared to just a decade ago. High-frequency trading firms now process market data and execute trades faster than you can blink. The competition among market participants has become so intense that even small inefficiencies are quickly arbitraged away. And now for the most counterintuitive part. The more people who don't believe in market efficiency, the more efficient markets become. This is the great paradox of market efficiency. When traders and investors actively search for market inefficiencies to profit from them, they help eliminate those very same inefficiencies. It's like a self-cleaning oven. The heat of competition burns away the inefficiencies. Take the case of post-earnings announcement drift, where stock prices continue to move in the direction of earnings surprises for several days after the announcement. In the past, this effect was significant enough to be profitable. But as more traders attempted to exploit this pattern, the effect has diminished. Research shows that for large-cap stocks, the post-earnings drift has become much weaker, though it still persists more strongly in smaller, less analyzed stocks. This brings us to a crucial insight. Market efficiency isn't binary. It exists on a spectrum. Markets are more efficient for large, widely followed stocks, and less efficient for smaller, more obscure securities. They're more efficient for simple information and less efficient for complex information that requires sophisticated analysis. Let's play detective and examine the most famous cases of investors who supposedly beat the market. What we'll uncover might surprise you. First, let's look at Warren Buffett, often cited as living proof that markets aren't efficient. But recent research tells a fascinating story. About 66% of Buffett's outperformance can be explained by systematic exposure to specific factors like value, quality, and leverage. Breaking this down further, 7% comes from the value factor, 2% from the low risk factor, and 2% from the quality factor. What's left, the true alpha of 3.6%, isn't even statistically significant. In other words, much of Buffett's success comes from consistently exploiting well-known market factors, rather than finding unique opportunities. Then there's Renaissance Technologies' Medallion Fund, perhaps the most successful hedge fund in history. Their long-term Sharpe ratio of 2.5 after costs is extraordinary, considering the market average ranges from 1.0 to 1.5. But here's the catch. The fund closed to outside investors years ago and manages only employee money. Why? Because their strategies work only at limited scale. The moment they try to deploy too much capital, the inefficiencies they exploit disappear. The story of Peter Lynch's Magellan Fund offers another crucial insight. While Lynch's performance was spectacular, research on mutual fund performance shows that only 30% of active fund managers who were top performers from 2010 to 2014 managed to beat the median in the following 5 years. Even more striking, none of the equity funds in the top quartile in 2015 remained there consistently through subsequent years. First, transaction costs are the silent killer of many seemingly profitable strategies. What looks like market inefficiency on paper often disappears once you factor in the costs of actually executing trades. Global macro hedge funds provide a perfect example. While they often show impressive gross returns, their net of fee performance tells a different story. Second, we suffer from survivorship bias when looking at successful investors. We remember the winners and forget the thousands who tried similar strategies and failed. It's like focusing only on lottery winners and concluding that playing the lottery is a good investment strategy. Third, when we properly adjust for risk, many apparent cases of market-beating performance disappear. This is particularly evident in the analysis of hedge fund returns. where higher returns often simply reflect higher risk-taking rather than true market inefficiency. Perhaps most telling is how the speed of price adjustment to new information has accelerated. In the early 2000s, it might take days for markets to fully process new information. Today, with algorithmic trading, modern exchanges can process and react to information in as little as 3 milliseconds. This enhanced efficiency makes sustained market-beating performance increasingly difficult, especially for larger funds. Let's conduct an experiment. Imagine you discover what seems to be a foolproof way to beat the market. You publish your findings, and suddenly, the opportunity disappears. This isn't hypothetical. It's exactly what happens to most documented market anomalies. Take the January effect, the tendency for stock prices to increase in January more than in any other month. When researchers first documented this pattern, it seemed like a clear violation of market efficiency. Buy in December, sell in January, profit. But studies show this effect has significantly weakened since its discovery, with some attributing this to investors becoming aware of the trend and adjusting their strategies accordingly. Or consider the small firm effect, where small companies historically outperformed large ones. G. William Schwartz research shows that this differential performance has largely disappeared since the initial papers that discovered it. The post-earnings announcement drift offers an especially fascinating case study. This is where stock prices continue moving in the direction of earnings surprises for days after the announcement. Recent research shows this effect varies dramatically by market cap. For larger firms, the drift has become much weaker, with prices adjusting almost immediately. However, smaller firms still show a more pronounced, delayed price response, suggesting that market efficiency operates on a spectrum rather than as an absolute. But here's where it gets really interesting. For each of these apparent inefficiencies, we need to ask, is this really an inefficiency, or is it just compensation for risk? Small firms might offer higher returns because they're riskier. This brings us to the adaptive market hypothesis, proposed by Andrew Lo as a modern refinement of EMH. Instead of markets being either efficient or inefficient, this theory suggests that market efficiency evolves over time as market participants adapt and learn. It's like an ecological system where strategies that work attract imitators until the opportunity is competed away, forcing traders to find new strategies. The evidence supports this view. High-frequency trading has dramatically improved the speed of price adjustments. Modern exchanges can now process and react to information in as little as 3 milliseconds, compared to the days or weeks it might have taken in the past. Consider the data on institutional investors. Their average portfolio turnover rate is now approximately 20% per year, leading to about $1 trillion in reallocations annually. This intense competition means that any obvious inefficiencies are quickly arbitraged away. Yet simultaneously, this competition is what keeps markets efficient. A beautiful paradox at the heart of modern finance. Here's a puzzling statistic. Between 2020 and 2024, only 30% of active fund managers consistently outperformed their benchmark indices. Yet institutional investors continue to pour trillions of dollars into active management strategies. This seeming contradiction reveals one of the most fascinating paradoxes in finance. Let's start with a simple truth. Active management is a zero-sum game. For every investor who beats the market, another must underperform by the same amount. After all, the market return is just the weighted average of all investors' returns. But it gets worse. Once you factor in trading costs and management fees, active management becomes a negative-sum game. The average active investor must underperform the market by the cost of trying to beat it. So why do sophisticated institutional investors continue to pursue active strategies? The data is brutal. According to S&P Dow Jones Indices research, none of the equity funds that were in the top quartile in 2015 maintained that position consistently through subsequent years. Zero. Not a single one. But here's where it gets interesting. Active managers play a crucial role in making markets efficient, even when they fail to beat the market. When they analyze companies, trade on information, and try to identify mispriced securities, they help incorporate new information into market prices. Consider high-frequency trading firms. They've reduced the average time for price adjustments to new information to as little as 3 milliseconds. This makes markets more efficient, but it also makes sustainable outperformance increasingly difficult. The structure of the investment industry itself perpetuates this cycle. Fund managers need to show they're doing something to justify their fees. This leads to what economists call institutional imperative, the tendency for managers to act even when action is unlikely to benefit their clients. The result? An average portfolio turnover rate of 20% per year among institutional investors, generating approximately $1 trillion in annual reallocations. But perhaps the most profound insight comes from Warren Buffett's track record. Recent analysis shows that about 66% of his historical outperformance can be explained by systematic exposure to factors like value, quality, and leverage. Only a tiny portion, an alpha of 3.6%, remains unexplained, and even that isn't statistically significant. This creates a fascinating feedback loop. The more people try to beat the market, the more efficient it becomes, making it harder to beat the market, which then requires more sophisticated attempts to beat the market, making it even more efficient. It's like a cosmic game of cat and mouse, where the very act of chasing creates the thing being chased. We began with a joke about an economist refusing to pick up a $100 bill on the sidewalk. Now we understand that the reality is more nuanced. There might be $100 bills out there, but they're usually taped to the back of a grizzly bear. The evidence is clear. Markets have become increasingly efficient. High-frequency trading can now process information in as little as 3 milliseconds. The percentage of active managers beating their benchmarks has fallen to just 30%. Even Warren Buffett's legendary performance can be largely explained by systematic exposure to known factors. But perhaps the most profound insight is that market efficiency isn't a destination. It's a journey. Like a perpetual motion machine powered by greed and fear, the very act of trying to beat the market makes it more efficient, which in turn drives more sophisticated attempts to beat it, creating an endless cycle of adaptation and evolution. If you discovered a seemingly reliable way to beat the market, what forces would likely emerge to eliminate this advantage? Think about how quickly information spreads in today's connected world, and how capital would flow to copy successful strategies. How might markets be less efficient if everyone believed in market efficiency? Consider the paradox that market efficiency requires people to believe markets are inefficient enough to make searching for opportunities worthwhile. Can you think of a market situation where having more traders trying to beat the market might actually reduce efficiency? Consider scenarios where crowd behavior and herding might lead to bubbles or crashes. If markets are efficient, why do we still need active traders and analysts? Think about who does the work of incorporating new information into prices, and what would happen if they all stopped. These questions reveal a deeper truth. Market efficiency isn't binary. It's a dynamic, evolving process that depends on the very people who doubt its existence. Understanding this paradox is crucial for anyone hoping to navigate today's financial markets successfully.